So if you watch the evening news, the narrative you get is, well, pretty straightforward. It's the United States and the BRICS nations locked in this high-stakes financial Cold War.
Right. It's always framed as a totally binary conflict.
Exactly. But if you look at the balance sheet of like a rapidly growing tech firm in Beijing or a green energy hub in Mumbai, the capital funding that expansion is often coming straight from the retirement accounts of school teachers in Texas or, firefighters in Ohio.
Yeah, and it completely shatters the whole illusion of borders. I mean, we are so conditioned to view global power as this contest between nation states, flags, presidents, physical territory.
Right.
But the actual capital flows tell a completely different story.
Welcome to the Deep Dive. Today, we are tearing down that geopolitical theater to examine the actual financial plumbing running beneath the global economy. Our map for this journey is a phenomenal May 6, 2026, post by Mark Wells. It's titled The Invisible Architects.
The core premise here is just fascinating.
It really is. The premise is that true global power isn't held by politicians making speeches at the UN. It's actually held by the big three asset managers. So that's BlackRock, Vanguard, and State Street.
Right. Institutions that are managing more wealth than the GDP of almost every nation on Earth.
Yeah.
And the source material focuses on how these three entities are navigating the two most defining geopolitical shifts of our time. On one side, you have the rise of the BRICS alliance, Brazil, Russia, India, China, and the new members aggressively pushing for multipolarity.
Moving away from Western financial dominance.
Exactly. And then on the other side, you have the Western corporate philosophy, the Great Reset, championed by the World Economic Forum, advocating for stakeholder capitalism.
Normally, these two forces are framed as irreconcilable enemies, right? The old guard versus the new world order.
Yeah, a bitter divide.
But Wells argues something incredibly counterintuitive. He suggests these asset managers aren't caught in the crossfire at all. They are actually the invisible bridge connecting both sides of this divide.
Okay, let's unpack this. Let's start with the BRICS connection.
So the stated goal of the BRICS coalition is to build a development-centered financial architecture. And a massive part of that strategy is, de-dollarization.
Right, moving away from the US dollar.
Exactly. They want to trade, build infrastructure, and scale their economies without being reliant on the dollar or the Western banking systems that hold it. They basically want to bypass Washington's financial hegemony entirely.
Which sounds like an existential threat to Western financial institutions.
You would think so.
But the irony Wells points out is staggering. The primary vehicles funneling Western investment into these BRICS markets are actually firms like BlackRock and Vanguard. They are actively funding the coalition that is supposedly trying to dismantle Western dominance.
Yeah, it's wild.
How does the actual mechanism of that work, practically speaking? It works through the sheer scale of modern financial instruments. Primarily, we are talking about massive emerging market exchange traded funds, or ETFs, and private credit networks.
Okay, ETFs.
Right. For anyone casually investing, an ETF bundles hundreds of different investments into a single tradable asset. These asset managers create massive portfolios specifically targeting the global south.
Oh, I see.
Yeah, so they pool capital from Western pension funds, institutional investors, and millions of retail accounts. And then they systematically deploy that liquidity into companies headquartered in places like Brazil, Saudi Arabia, or China.
So if a tech company in a BRICS nation needs, say, $500 million for a new server farm to compete globally, that vital liquidity isn't just coming from their local government.
Not at all.
A huge chunk of it is flowing directly from a Vanguard or BlackRock emerging market fund.
Exactly. And what's fascinating here is how these massive Western firms treat the rise of a rival global power bloc, because they don't view de-dollarization or multipolarity as a threat to be crushed.
They view it as a diversification strategy.
Precisely. A macro-level diversification strategy. They are literally supplying the capital that makes the BRICS vision physically operational.
It's the ultimate version of selling shovels during a gold rush, except you're selling shovels to two rival mining camps who are actively trying to sabotage each other's operations.
Right.
You do not care which camp strikes gold as long as both camps bought their equipment from your store.
That analogy hits the nail on the head. They are totally untethering their success from the success of any single nation state.
Well, wait, let me push back on this because there's a gaping hole in that strategy, right? If the BRICS nations actually succeed in de-dollarizing the world economy and the US dollar collapses as the global reserve currency, the Western retail wealth that firms like Vanguard rely on, those firefighters in Ohio, their 401k plans evaporate.
True.
So how do the asset managers survive if their primary customer base back home goes completely broke?
Well, that assumes their survival relies entirely on American retail investors, which honestly hasn't been true for a long time. Yeah. The source points out that the big three have entrenched themselves deeply into sovereign wealth funds, Middle Eastern capital reserves, and institutional money all across the globe.
Oh, wow. Okay.
So yes, a US dollar collapse would absolutely devastate their Western retail portfolios. But their emerging market portfolios, which are fueled by non-Western institutional capital, would skyrocket in value. They are basically hedging against the volatility of the American empire itself.
So they have effectively immunized themselves against global geopolitical fallout.
Pretty much.
If Washington stays on top, their U.S. index funds thrive. If Beijing or Riyadh takes the lead, their emerging market funds explode. They win the board game regardless of who rolls the dice.
By maintaining massive stakes in both the established Western order and the insurgent global South, they just remain the ultimate middlemen. Capital without borders.
Which naturally leads to a massive question. If these firms are playing both sides abroad to insulate themselves from geopolitical risk, what are they doing with all that aggregated power back home? How does this massive pool of capital translate into actual corporate control?
And that transitions us right into the concept of the Great Reset.
Right.
Moving from geopolitics to corporate philosophy, the World Economic Forum's concept of the Great Reset is fundamentally about shifting from shareholder primacy to stakeholder capitalism.
So, for decades, the dominant logic, often associated with Milton Friedman, was that a corporation's sole responsibility was to maximize profits for its shareholders.
Right. But the Great Reset argues that companies must be accountable to a wider range of stakeholders. So the environment, local communities, social equity, things like that.
And the article points out that these asset managers are no longer just passive observers in this philosophical shift. They have actually become what Wells calls systemic enforcers.
Yes, systemic enforcers.
They use environmental, social, and governance, or ESG metrics, not just as suggestions, but as mandatory technical requirements.
They are the ones actually enforcing the transition. And the mechanism they use to do this is crucial to understand.
Here's where it gets really interesting, because the mechanics of this are entirely hidden from the average person. If BlackRock or State Street are just holding our retirement funds, how do they have the actual muscle to force a global corporation's boardroom to comply with, like strict carbon emission disclosures or diversity mandates? Where's the leverage?
The leverage comes from what the source calls the power of the proxy.
Okay.
This is the engine of modern corporate governance.
Yeah.
When you put $500 a month into a standard S&P 500 index fund, you are buying the economic value of a tiny sliver of Apple or Exxon or Microsoft. But you relinquish the voting rights associated with those shares.
I see.
The asset manager holding the fund aggregates all those voting rights.
So they pool the money of millions of regular workers, strip the voting rights away from the individuals, and walk into an annual shareholder meeting wielding a massive voting block.
Precisely. They might hold 5, 10, or even 15% of a company's total voting power.
They don't just hold the stocks, they vote on them.
Exactly. By weaponizing this massive proxy voting power, they can swing boardroom elections. They can force the adoption of specific ESG policies. Like, if a CEO refuses to implement a desired carbon transition plan, the asset managers can literally vote to oust the board of directors.
That is nuts. A retail investor's own 401k contribution is actively being weaponized to enforce policies at the very companies they might work for.
It is a global regulatory framework operating completely outside of any single government's jurisdiction. They are legislating corporate behavior worldwide through sheer financial leverage.
And that level of unaccountable influence obviously generates friction.
But absolutely.
And we need to be clear about the political reality here, remaining totally impartial. The source notes that by the time this post was written in 2026, there was massive political pushback against ESG mandates in the United States. We're seeing different state pension funds pulling billions of dollars out of these firms.
Right.
They're arguing that asset managers should only care about financial returns, not social engineering. And again, we aren't taking a stance on whether ESG is fundamentally good or bad here. We are just highlighting the sheer raw power being leveraged to enforce it.
Yeah, and the article explicitly points out how the big three are fracturing under this specific pressure. Vanguard, for example, recently settled major anti-ESG litigation.
Wait, really?
Yeah, and they have started taking a slightly more passive approach, allowing some retail investors to direct their own proxy votes just to mitigate that political risk.
While simultaneously you have BlackRock and State Street sort of doubling down but rebranding their approach. They are framing sustainability and governance strictly as material risk factors. They argue to these angry state treasurers, hey, we aren't doing this for ideological reasons. We are doing this because climate volatility and poor governance are actual financial risks to your bottom line.
Right. They are adapting their language to maintain their grip on the proxy machinery. But even proxy voting is starting to look like an old-school tool.
Because the next massive shift the article details moves us out of the boardroom and into the physical, literal foundations of the future economy.
The 2026 inflection point.
Right. We are moving from the philosophical arguments of stakeholder capitalism directly into the hard realities of the fourth industrial revolution. And the scale of capital being deployed here is almost incomprehensible. The article highlights a recent staggering announcement. BlackRock, Microsoft, and NVIDIA partnered to inject $100 billion into AI data centers and power infrastructure.
$100 billion. It signals a profound evolution in strategy. These firms are no longer satisfied with merely buying shares of tech companies on the open market. They are directly funding and owning the physical infrastructure required to keep those tech companies operational.
It makes me think of an analogy. Let's say the global economy is a massive casino. For the last 30 years, asset managers were content just to own the largest stack of chips on every table. They used proxy voting to tell the dealers how to deal the cards.
Okay, I like that.
But now it's like they've realized, why just manage the chips? Let's buy the power plant that keeps the casino's lights on.
Right.
Because if you own the electrical grid, it doesn't matter who wins at the blackjack table. The entire building relies on you just to function.
If we connect this to the bigger picture, that analogy perfectly captures the mechanism of their new power. Artificial intelligence requires an unimaginably massive amount of electricity, cooling systems, and physical server space.
Absolutely, Matt.
By partnering with tech giants to build this specific infrastructure, these asset managers are locking down the crucial energy and data loops that will dictate all economic growth for the next decade. They are moving from the abstraction of financial markets into the hard reality of watts and concrete.
But the infrastructure grab doesn't stop at data centers. Wells introduces the concept of tokenization, which, sounds like a crypto buzzword, but the actual mechanism of it is wild.
It really is.
For anyone unfamiliar, tokenization is the process of taking a massive, illiquid physical asset, like a commercial skyscraper, an airport, or a city's toll road, and representing ownership of it as digital tokens on a blockchain.
Right. Traditionally, infrastructure is highly illiquid. If a city wants to sell a toll road, it takes years of legal wrangling. Tokenization breaks that massive physical asset down into millions of digital shares that can be traded instantly, 24/7, on global markets.
It takes the slow physical world and makes it as liquid as a tech stock.
Yep.
But how does making a toll road easier to trade actually alter the power dynamics of your daily life? The article claims this embeds their influence deeper into our existence, but what is the actual mechanism there?
Well, think about how a traditional toll road works. The pricing is usually set by a local city council or a regional transit authority, right? Based on the needs of the local community.
Sure.
But if that toll road is tokenized and owned by global asset management funds, the pricing mechanism changes. Suddenly, the cost of your morning commute isn't decided by your local mayor. It could be adjusted dynamically, second by second, by an AI algorithm sitting in London or New York.
Oh, wow.
An algorithm designed to maximize yield based on global liquidity needs.
So local sovereignty is just stripped away and replaced by the demands of a global digital market.
Exactly that. From the energy grid powering your home, to the logistics hubs delivering your food, to the digital IDs you might soon carry to access those services. If all of these physical touchpoints are tokenized and traded on platforms controlled by these institutions, their reach bypasses your retirement account entirely.
It integrates directly into the very fabric of how you live, move, and consume.
Yes.
So what does this all mean? We have covered massive ground today. We started by looking at how the big three are quietly funding the BRICS nations' attempts to de-dollarize through emerging market ETFs. We explored how they use the mechanism of proxy voting to force Western corporations into compliance with the Great Reset.
Right.
And finally, we looked at how $100 billion AI infrastructure deals and the tokenization of toll roads are embedding their power into our physical reality.
The ultimate takeaway from Mark Wells' analysis is that the grand, sweeping narratives we consume every day, The existential war between Western stakeholder capitalism and BRICS multipolarity are largely a performance.
Yeah.
While politicians argue over borders, tariffs, and currencies, the asset managers are actively managing the global transition itself.
They don't care about the outcome of the political theater because they own the stage it's being performed on.
This raises an important question about the nature of sovereignty in the 21st century. The article concludes that capital has become the ultimate diplomat. What we are witnessing is the birth of corporate sovereignty.
Corporate sovereignty.
Yeah. Think of them less like traditional banks and more like a global operating system like iOS or Windows. They don't care which app you use or whether that app was coded in Washington or Beijing, because they control the underlying environment that every single app requires to run.
It fundamentally rewrites how you should process the daily news.
It does. They aren't loyal to the West and they aren't loyal to the East. They are strictly loyal to the mechanics of the liquid, data-driven market they are currently building.
Which leaves us with a final, slightly chilling thought for you to mull over. If these massive asset managers are truly achieving this level of corporate sovereignty, if they are effectively untethering themselves from the fate of any single nation-state and controlling the tokenized infrastructure of our daily lives, who exactly is going to tax them or regulate them? Because if the invisible plumbing of the global economy operates completely outside the jurisdiction of any government, well, the plumbers get to write their own laws. Thank you so much for joining us on this deep dive. Keep questioning the narrative, look past the borders on the map, and we will see you next time.